You might think being smart is the best shield against losing money. After all, if you have a high IQ, advanced degrees, or a killer job title, you're probably immune to dumb financial mistakes, right? Well, think again. Let me tell you about a friend of mine. Let's call him Mark. Mark is brilliant. PhD in engineering, works for a top tech firm, reads every financial report like a pro, yet he lost nearly $500,000 in what he proudly calls the greatest miscalculation of my life. Mark's mistake wasn't a lack of knowledge. It wasn't ignorance. He had all the facts, the data sets, charts, you name it. But here's the kicker. Despite all his smarts, he fell victim to emotional bias. Yes, intelligence does not protect you from emotional bias. In fact, it often makes it worse. Why? Because the smarter you are, the more convinced you become that your analysis is flawless. You start to believe you're above the herd mentality, above the panic selling and the wild speculation. You think you're in control, and control is an illusion. If your financial plan is based on hope, that's a problem. Hope is not strategy. Mark hoped the market would turn around. He hoped his gut feeling was right. He hoped the news was just noise, but hoping doesn't pay the bills. This is where most people quietly lose money. The ones who are too confident in their own intelligence to see the emotional traps they're walking into. They get stuck in confirmation bias. They overtrade. They hold on to losing positions because they know better. So why do smart people make catastrophic financial mistakes? This video will break down the exact reasons. No fluff, no quick fixes, just the real deal on how intelligence alone can be your worst enemy in investing. Stick around. You'll want to hear this. I'm Jack Miller. I've been in the investing game for over 15 years. I've lived through market crashes that wiped out entire portfolios overnight, endured crypto winters that crushed hype and hope alike, and made my own share of mistakes, some expensive, some embarrassing. Early on, I jumped into crypto right at the peak of the 2017 frenzy. I thought I had it all figured out, did my research, followed the charts, felt confident. Spoiler alert, I didn't. I held too long, ignored warning signs, and watched a big chunk of my money evaporate faster than I expected. That loss taught me more than any winning trade ever could. Here's the truth nobody wants to admit. The market doesn't punish stupidity.
It punishes overconfidence. It doesn't care how many degrees you have or how many books you've read. It doesn't care if you've cracked complex algorithms or memorized economic theories. It simply exploits your mistakes and your hubris. So if you think being smart means you're safe, think again. Overconfidence is the real killer.
And recognizing that is the first step to not becoming the next cautionary tale. I'll show you how to avoid these traps. Imagine two drivers, one highly intelligent, with perfect knowledge of traffic rules and road signs, and another, seasoned, disciplined driver who follows a set routine, stays alert, and manages their vehicle with patience. Who will reach their destination faster and safer? Clearly, the disciplined driver, even without extensive technical knowledge, is more likely to arrive without accidents or tickets. The smart driver might know all the rules but could risk speeding, distracted driving, or taking unnecessary risks. Investing is like driving on a complex, unpredictable road. Theoretically, if you understand all the rules and have a map, you might think you're in control. But as soon as you hit a blind turn or a treacherous patch, it's your discipline, patience, and emotional control that determine whether you make it safely. Even the smartest driver can get into a crash if they react emotionally or abandon their routine. A close friend of mine, Alex, is an engineer with an impressive education. He understands markets, technical analysis, and economic theories inside out. But he constantly trades impulsively, driven by news or feelings rather than a system. Last year, he lost nearly half his savings because he ignored his rules and let emotions dictate his decisions. Why? Because knowledge alone isn't enough. Discipline, consistency, and emotional mastery are what keep you safe over the long haul. Remember, intelligence is a tool, not a guarantee. The real edge comes from discipline and following a well-thought-out system, not chasing hot tips or reacting to market noise. Practical steps you can take right now. Stop treating investing like a guessing game. Here's what to do. 1. Write down your rules. Define when you buy, when you sell, and stick to it. 2. Use stop losses. Yes, those little lines that seem like overkill actually save your butt.
3. Check your emotions. Before making a trade, ask yourself, am I doing this because I think it's smart or because I'm scared I'll miss out? 4. Review your mistakes weekly. Don't just shrug them off. Look at what went wrong, how you felt, and what you can fix. 5. Automate what you can. Recurring investments, automatic rebalancing, anything to remove your ego from the equation.
Smart people love to convince themselves they can figure it out. With enough data, charts, and fancy spreadsheets, they believe they've cracked the market's secret code. That's the illusion of control, and it's as real as it is dangerous. Overconfidence bias kicks in like clockwork. Suddenly, your brain isn't just good, it's infallible. You start overestimating your ability to predict the next move, telling yourself, I've done my homework. I'm not like those clueless investors. Remember tech investors in the last bull run? They were absolutely certain the market would only go up. Every little dip was just a buying opportunity. Any hint the market might stumble? Nope, their models didn't include that. Surprise, it did. The problem isn't being wrong, it's being unaware you're flying blind. The more you believe you're in control, the harder reality smacks you down. So, why does this keep happening? Why do the smartest folks keep walking right into the same trap? Here's where things get interesting. Smart people don't just make bad decisions, they rationalize them. They wrap emotion in a nice, neat package called logic. It sounds convincing, so convincing that even they start to believe it. Confirmation bias does most of the heavy lifting. Once you pick a side, you start hunting for information that supports your choice. Ignore anything that contradicts it. Reddit threads, Twitter feeds, finance forums, they become echo chambers, not sources of truth.
If you're scrolling through comments looking for validation instead of facts, that's a problem. You're not investing. You're comforting yourself. It's easy to mistake noise for insight when everyone around you is nodding in agreement. This is where most people quietly lose money.
They don't see the warning signs because their brains are busy defending the decision they already made. Logic becomes a cloak for emotions they refuse to face. If your financial plan is based on hope, that's a problem. And hope, disguised as clever reasoning, is the most dangerous kind. For a lot of people, investing isn't just about making money. It's about proving something, usually to themselves, sometimes to everyone else. Money becomes a status symbol, a badge of intelligence. If your portfolio looks impressive, it means you're smart, right? That's ego talking. When ego leads, decisions stop being about sound analysis and start being about reputation. It's why you see bold predictions plastered all over social media and finance blogs. It's why people double down on risky bets just to save face. Public predictions are dangerous. They lock you into a story you have to defend, no matter what the market says. Changing your mind feels like admitting defeat, so you hold on longer than you should. This isn't just a quirk. It's a psychological trap that costs smart people real money. Because when your ego's on the line, logic often takes a back seat. Investing isn't just about numbers and strategies. It's about managing yourself. Our biggest obstacle is often our own emotions. Fear, greed, hope, pride. These feelings can override rational judgment and lead to costly mistakes. Think back to the market crash of 2020. Many investors panicked when stocks plummeted and sold at the worst possible time. Others doubled down, hoping the market would bounce back quickly. In both cases, emotional responses, fear and greed, overpowered logical decision-making, leading to losses. Investing is like playing poker. You might have a strong hand, but if anxiety or overconfidence causes you to bluff recklessly or fold prematurely, you risk losing. The key is emotional control, knowing when to stay disciplined and stick to your plan, regardless of the noise around you. Psychological trap. A common trap is confirmation bias, seeking out information that supports your existing beliefs while ignoring red flags. For example, If you're heavily invested in tech stocks that are rising, you'll tend to dismiss negative news, convincing yourself the trend will continue. But deep down, you're avoiding the discomfort of admitting your position might be wrong. Practical tip: develop self-awareness. Before making any investment move, ask yourself, am I doing this out of fear or greed?
Or because I've followed my plan. Practice taking a pause to assess whether your decision is driven by emotion or logic. Use rules and systems to keep emotions in check. Mastering your mind. The truth is, your brain is a drama queen. Fear, greed, pride, and hope all scream louder than logic. Smart people think they can outwit these emotions. They can't.
Your job is to notice the drama, not join it. One trick? Name your emotions out loud. Ah, that's fear talking. Thanks, brain. I see you. Suddenly the power shifts. You're observing, not reacting. Emotional control isn't about feeling nothing. It's about feeling smart, not stupid, when markets get messy. Let's talk about the hype trap. It's where even the smartest investors get caught. They see a trend, hear the buzz, and think, I need in. By the time they act, the early gains are long gone. Take the NFT mania. In 2021, everyone was minting and flipping digital art for ridiculous sums. By the time the so-called experts jumped in, the market had already peaked and started its inevitable decline. Remember Elizabeth Holmes, the biotech wunderkind? She had brains, charisma, and billions on paper, but she got blinded by hype and her ego. She ignored warning signs, lied to investors, and crashed from billionaire status to criminal charges. Her intelligence didn't save her. Her emotions and pride did the exact opposite. The lesson? Brains without humility are like a Ferrari with no brakes, fast, flashy, and guaranteed to crash. Then there were the meme stocks. Reddit threads and Twitter feeds pumped up stocks like GameStop and AMC. The smart money. They were already out, cashing in on the frenzy. The latecomers? They were left holding the bag when the bubble burst. The AI bubble is another classic. Tech giants like Nvidia saw their valuations skyrocket as AI became the buzzword of the decade. By the time the analysts and investors piled in, the stock had already been bid up to unsustainable levels. And let's not forget the crypto cycles. Bitcoin and altcoins surge, and suddenly, everyone's a crypto expert. The early adopters made their fortunes. The latecomers? They bought in at the top, only to watch their investments plummet. This pattern repeats because intelligent people often mistake late entry for smart timing. They think they can time the market, but by the time they act, the opportunity has passed. Here's a bias that quietly ruins more portfolios than you might think: the I'm the exception bias. You know the line. Yes, most people lose money investing, but not me. I'm different. It's comforting, isn't it? It puts you in a special category, above the crowd, immune to the common pitfalls. But here's the inconvenient truth. Almost nobody sees themselves as average. We all believe our strategy is unique, our analysis superior, our timing perfect.
That belief isn't just harmless confidence, it's a cognitive blind spot. It blinds smart investors to the reality that they're more likely to follow the same patterns, make the same mistakes, and suffer the same losses as everyone else. Look at the survival rates of investors. The numbers aren't flattering. A large majority underperform the market over time. Many lose money, yet somehow, most investors still think they'll be the outliers, the ones who beat the odds. That's not just optimism, that's overconfidence disguised as hope. This bias leads to costly behavior, doubling down on losing trades, ignoring warning signs, chasing hot tips, or refusing to cut losses because admitting a mistake feels like admitting failure.
The problem isn't just that people fail, it's that they don't see themselves failing until it's too late. If you think you're the exception, ask yourself, how often have you reviewed your investment mistakes honestly? How often do you actively seek out information that challenges your views instead of confirming them? Because real progress starts with acknowledging that you might be just like everyone else, not worse, not better, just human. Recognizing this bias isn't a blow to your ego, it's a survival tool. It's the difference between learning from the crowd and getting lost with it. The market isn't your logic puzzle. Here's something every investor needs to hear, but few want to admit. The market isn't a logic puzzle you can solve if you just think hard enough. It's not a Rubik's Cube you twist until all the colors line up. It's a probability game, and probability doesn't care how brilliant you are. You can have the sharpest mind, the fanciest charts, the most sophisticated models, and still lose. The market moves on countless factors, many of which don't make sense, aren't predictable, and often defy logic altogether. It's humbling, it's frustrating, and that's exactly why overconfidence is such a dangerous trap. The system is bigger, faster, and more complex than any one person can fully grasp or control. Sometimes, the smartest move is admitting you're part of a game that doesn't bend to your will, and that's where real investing begins. Even the biggest players are tasting humble pie. Bitcoin and Ethereum are having one of their worst starts to 2026, both bleeding hard after peaking in late 2025, shaking out leveraged bets left and right. Coinbase, the largest U.S. crypto exchange, just reported hundreds of millions in losses as volumes cratered and volatility spiked. Tom Lee's camp is buying the dip with tens of millions, despite billions in unrealized losses on Ethereum positions. That's like doubling down on ketchup stocks, knowing ketchup demand just tanked. Brevan Howard's crypto fund, backed by billionaire Alan Howard, lost nearly 30% thanks to the crypto slide. Even smart money isn't immune. And if you think that's just a minor wobble, nope. Record multi-billion-dollar liquidations, massive ETF outflows, and leveraged positions being pulled back from institutions tell a brutal story. If some of the biggest players are getting their lunch eaten, a PhD with 100 charts isn't suddenly bulletproof.
Let's talk about what actually works for long-term investing. Relying on predictions and gut feelings is a surefire way to fail. That's not an opinion. It's backed by decades of market history. The first key is systems, not crystal balls, not fortune-telling. Systems are repeatable processes you can follow regardless of what the market throws at you.
Think of it like a recipe. If you follow it, you don't need to worry whether the ingredients turn out right. In investing, that might mean dollar-cost averaging, periodic rebalancing, or a disciplined approach to valuation. Whatever your system is, you need to execute it consistently, even when headlines scream or markets crash. No one can predict the future with certainty. Even the best analysts fail to consistently call short-term moves. Long-term success comes from managing risk, not trying to avoid it entirely. Good systems include risk controls, stop-loss levels, diversification, avoiding overconcentration. You can't eliminate risk, but you can control it. Discipline beats IQ. Discipline is the real edge. A highly intelligent investor can devise the most elegant models, but without discipline, they're doomed. Smart investors might know the fundamentals, but if they abandon their process during a drawdown, impulsive decisions like panic selling or chasing hot trends will wipe out long-term gains. Discipline is trusting your system through ups and downs, not second-guessing yourself every time volatility spikes. Repeatable processes need to be adaptable. Markets evolve, circumstances change, assumptions fail. A good framework adjusts without losing sight of the long-term goal. For example, holding a diversified basket of assets requires periodic rebalancing to maintain target allocation. That's not weakness, it's process in action, avoiding the hype trap. This isn't about chasing the latest mania or trying to time the top or bottom. That's gambling, not investing. Long-term investors accept they won't get everything right, but a system keeps you on track even when you're wrong, which you will be. Risk management shines here. Know your risk tolerance and stick to it. Most people don't lose money because they were wrong. They lose because emotions override discipline. Focus on systems, not predictions. Build a process you can follow without second-guessing. Discipline and risk controls turn investing into a marathon, not a sprint. Winners treat it as a craft, not a guessing game. Two types of investors. The analytical investor loves to analyze every scenario, trying to predict market moves. They believe intelligence is an edge, often overthink, and get trapped in short-term swings. The system-based investor accepts uncertainty, limits risk, and follows clear, repeatable rules. They won't be right every time, but they trust the system to protect them. The difference is mindset. Intelligence without discipline is a ticket to emotional swings and poor long-term results. A process-based approach isn't glamorous, but it works. Your intelligence alone is not your edge. Short-term wins are possible, but long-term success comes from discipline. Stick to your process when emotions run high, when markets are messy, when everyone else panics. That separates successful investors from those who burn out or lose it all. Investing isn't about showing off genius. It's about showing up consistently, making tough calls when your heart screams, sell, and trusting your system when everyone else panics. Be disciplined, laugh at your mistakes, and remember, the market doesn't care how smart you are. Play it steady, play it human, and you just might end up ahead. If you found this helpful, hit that subscribe button. I've already lined up plenty of exciting topics for you: strategies, real-life case studies, practical tips, and a little sarcasm to make investing less like boring accounting and more like a game you can actually enjoy.
Don't miss the chance to level up your skills and keep a smile on your face, even when the market throws another crypto roller coaster your way. Remember, discipline, systems, and a bit of humor are your best friends on the long-term journey.
Thanks for watching all the way through, and keep in mind, the market may be unpredictable, but your approach can always be sharp, steady, and even a little fun.